Saying we're not live now. You want to bring us in, Al? I'll keep refreshing this and we'll see if we can get technology working.
Yeah, good everybody. Welcome to the September OpenCorp Facebook Q&A from Quarantine Central in Melbourne. Myself, Al Lewison, got Cam McClellan and Matt Lewison with us. Cam and I in hats, me because I can't go to the barber. Cam, I don't know why.
Because I can't go to the barber either.
And Matt's cutting his own hair at home, so he's got his hat off tonight. But looking forward to a good show. Get the questions coming through. Lots and lots to talk about in property. The markets around the country very different, and lots happening at different points in time. I guess quarantine related, market related, but we're here to answer your questions tonight.
We'll keep it light for a couple of minutes and just let people load into it. What's going on with you, Al? Keep yourself amused?
No, I'm pretty impressed with what you just told me about the double screen going with the basketball in the background during the day. It's a great way to do it.
Yeah, so I've been, I basically run my work computer here, and the computer which I'm actually looking at here, and I'll run the Facebook questions tonight, is I just run the NBA full time. So.
And we know that there's more NBA than work, so just hide your family in your office.
Some good games going on, I'll tell you. Yeah, the Rockets Lakers are having a nice showdown.
Yeah, be tough for those guys locked in their little bubble. Can't leave Disney World very loud.
I feel sorry for them.
It's like the AFL footballers up in Brisbane just got into trouble because they're all partying too much.
That was horrendous on the news today. There was that family where the dad's dying, and they've been told to choose one that can cross the border and go and see their dying dad, and then you compare that to everyone else travelling interstate. It's just they'll sort that out, I'm sure, but pretty horrendous.
The basketballers couldn't take family though, Matt, so they're just literally them in their little room every day.
All right, property boys. What's happening? Boots on the ground. Louis, you're still talking to everyone. What are we seeing out there as far as, I don't want to delve straight into figures or anything like that, but I know yourself and John primarily in the acquisitions team have been talking to developers, and especially in some areas, this spike or this land rush hasn't stopped as yet in some areas. What's going on?
You stole the words right out of my mouth. So yes, absolutely, there's still a land rush, and it seems like land is the hottest commodity at the moment. Everybody's trying to get it. Developers are obviously trying very hard to service people who want to buy land, but they're really running tight on their stock list. They actually went through a period, as I'm sure you can imagine, through sort of March, April, May, June into July, not building anything because they were just worried about what was the demand going to be like, and they didn't want to have surplus stock. Now they've got a shortage. All of a sudden, they're drip feeding it onto the market, and yeah, if you can't turn things around pretty quickly, they'll just move on. And yeah, it's a incredible, I guess, turn of events in a few months' time from where everyone would have expected back in May.
Drip feeding is a really good term. I think drip feeding is a term, Louis, which comes from your yesteryear when you were the GM of the third largest land developer in Australia with a tender age of 26 back then, mate. You're not looking 26 anymore. But the term drip feeding is really poignant because drip feeding and the method of drip feeding stock to market is used when there's high pressure, so you can increase prices at each stage release. So it's a really strategic thing. And I know you just brushed over it, but run us through what that method is and how it works for developers.
Okay. So obviously for developers producing 100 lots in a stage, which obviously the bigger the stage, the more economical it is. If they're a big developer, they can generally afford to deliver 50, 100 lots. If you put 100 lots on the market at once, it seems like there's a lot of supply all of a sudden. So buyers feel like they've got choice. There's no urgency. And I guess the drip feeding is a method of delivering land in smaller sub-stages. So they deliver 10 to 12 lots in a stage, present that to the market. They're still constructing 100 at once, but they're presenting 12 at a time. Those 12 get snapped up really quickly because there's obviously a lot of people who want to get in and they go, oh, I don't want to miss out. There's only 12 of them. So they move quickly. Then 4 weeks later, they put another 12 lots on the market. They put the price up a few grand. So again, it just creates this sense that prices are clearly trending upwards, that there's constant demand and that they're constantly keeping their foot on the pedal in terms of getting that price growth and creating that sense of urgency. And actually there was the chairman of Peat Limited, where I used to work, was I think he was real estate of the year in Western Australia for years before he bought Peat Limited and turned it into the giant that it is today. And that was one of his big things as a land developer. It was always about sense of urgency. You have to create that for the market. Right now, nobody needs to manufacture it because there is a huge sense of urgency in that land market.
So Victoria, they extended because of, I guess, we're missing a window of time to take advantage of it. We're out to the end of March, I think it is.
Yeah.
What's happening around the rest of the country is they got that as well, or they're still end of December?
No, they're still end of December. So the way it's worded, the state government has the right to consider extending at their, I guess, at their leisure, I suppose, or discretion. In WA, they introduced a second stimulus that is overlaid on top of the federal government stimulus. That goes a little bit longer. But certainly most states at the moment are saying the contracts absolutely need to be signed before December, but they'll consider when construction commences if somebody applies for leniency, because obviously there's a lag now. Builders are swept off their feet trying to keep up. So,
and I probably should have given you notice on this question, but obviously the Perth government in their I guess state budget has thrown some extra money at it, and were they in a different position than the other states? And are you expecting to see anything? Victoria's going to need to do something, I guess, at the back of this, but are you expecting other states to come to the party there as well, or just it's unknown?
Yeah, look, so it was a surprise in some regards how they structured and how quickly they came out with the policy after the federal government. But for 6 weeks before the federal government announcement, we'd been hearing on the grapevine through our contacts in WA.
The worst kept secret in the country.
That's right. But that at one point the WA government was working on, I was told, a $50,000 stimulus package, $50,000 per lot to get construction underway. 2 weeks before the federal announcement, I was told that it had been put on hold because the federal government was taking on something and the states were now going to wait and see. So essentially the federal government offered 25 grand, the state government's offered another 20. So it's pretty close to the original 50 that was discussed. I guess it came as a surprise because every other state got a bounce out of the 25 grand that the federal government offered anyway, and so had Perth. So it didn't really need the extra stimulus. I think most states would be keeping their powder dry to come out with something later next year after this has all run off. And after I guess right now in Victoria, we're on idle, sitting at the traffic lights with a red light. There's not much point in revving the engine until you burn all your fuel. But I'd say more likely we'll probably see some changes to stamp duty next year. And that could be announced as early as October through I guess that's federal government, won't change stamp duties, but the federal government and the states should start to make some announcements pretty soon.
It's I think the housing stimulus, we know, is one thing that's happened after every major economic downturn. Housing stimulus is the main key driver, coupled with a number of others, because they like long-term tail stimulus as well as short-term. But housing, people, and we've talked about this recently, Louis, that housing stimulus, some people who don't like people buying houses and think capitalism is terrible, look at housing stimulus like the government's giving a hand to the uber rich, when the reality is, if the numbers that we played with the other day, a $750,000 purchase, a $20,000 government stimulus, to get that purchase to occur, the government makes about 135 grand in taxes and charges for that 20 grand out. So the government did pretty well out of it. A couple here, and probably it leads into what you're saying. Hey, Rowan, Nathan, Joe, Doris, thanks for jumping on. Quick one, Bucks fan Cam, no, I used to dabble with the Cavs, but now I just follow players around more. Once LeBron left, Alan and I actually went over to Cleveland a couple of years ago and watched the playoffs when LeBron's last year over there. Property related. Question from Nathan. This could work out with you, Louis. Sorry, mate. Mickleham, Melbourne, somewhere you would recommend to buy a first property, and why? Yes, no, Mickleham, we know it well.
We do. Look, there's some prices in Mickleham Mickleham's seen a lot of price growth in the last few years, and certainly we were active in Mickleham probably late last year. We moved out of that market a little bit, not to say that it's not a good place to buy. It's just that prices had shifted up more than surrounding areas. So on a value basis, we weren't seeing the value in Mickleham that we were seeing.
So a first home buyer may potentially not your ideal first choice?
Oh, well, look, a first home buyer who's going to move into a house, obviously there's a lot more to it than just from an investment perspective.
Correct.
And we look
That's what I
from an
wanna get to.
investor's perspective, where do we want to be in
Yep.
terms of value? As a first home buyer, we know that 90% of people will buy their house within 7 kilometres of where they've been living. So if I was to say that the southeastern suburbs of Melbourne was the best place to be in, I'm not saying that's the case. If somebody's living in Greenvale right now, they're not going to pack up and move out to Cranbourne. They're more likely to go to Mickleham or Wollert, or some areas out in that part of town. So
There's infrastructure happening though, or planned infrastructure, isn't there, that goes in there that over time will benefit that area pretty greatly.
Oh, the area is it's transforming really quickly, and there was a few years where it was just taking a long time to wind up. There was a fair bit of land supply potential, and there's obviously a huge amount of industrial land nearby as well. Yeah, all of a sudden in the last 2 years, the projects that have been delivered at really good quality. There's good local infrastructure going in with parks, shopping centres. There's obviously some long-term infrastructure that will go out that area, which is why we like that corridor generally. But yeah, as I said, it's from our perspective, we like to make sure that we're at any given point in time finding the best value that we can. And yeah, obviously, if you're a first home buyer looking to move into that area, I think you probably do okay. So yeah,
very good, very good. No, good. I think hopefully that's kept you happy. Rowan Boz slacking off tonight. Yes, he is, mate. He's having a night off with the family, so I'm sure he's probably listening in. So he'll probably give you a bit of stick. Joe has asked, should I renovate my property or try to get another investment property at the moment?
You're the renovation king, aren't you, Cam?
I used to be the renovation king. Al dubbed my initial
Named.
Well, it was named it, yeah, the McClellan Reno, which was what did I do? It was 5K the standard Reno. So I'd buy a house. This is early days. I've stopped buying established houses long ago. Just buy new properties for the last 15 years at least. But yeah, went through a strong stage of buy a house. I think for $5,000, I'd get McEwen's flat pack kitchen when McEwen's was around before Bunnings. Paint, carpet, tan bark. I think Felicity painted 6 or 7 houses before she hung up the paintbrush forever.
You get curtains in your Reno for $5,000 as well.
Curtains, yeah, from Spotlight, yeah, we'll sew those up. So
Sure, everyone
$5,000.
can imagine the quality that's going in.
And was weaving the carpets himself. That's how elaborate he was trying to say. That's how much money he was saving during this renovation.
That within that amount, I could tile a bathroom, throw a laundry trough in, a few odds and sods depending on what the house needed, but $5,000 would pretty much cover it. So
he's been carrying his toolbox around the office. He brings it into the office once a month just so that everybody knows that he once did a
once had the bag
to answer the question, I guess.
There you go.
Yeah. The way I'd probably look at it is what's going to make you more money in the longer term. So if the difference is, can I buy a house right now or I renovate? If it's one or the other, absolutely buy a new house, because the growth you get on the new property is far going to outweigh the little bit of increase in value you get out of the renovation. If the difference is I can't buy a property now, but by renovating, my valuation might go up, and that will help me along the journey, absolutely spend some money on your renovation, increase the value of your valuation, and that will put you on the path to the next property. So I used to look at it and still do. Everything you can do is a stepping stone to getting the next property.
Yeah, it's a good way to look. And I think the numbers, just to crystallise with that with you, the numbers are, if you think of it and go, if the amount you can put into a reno is enough for a deposit of the next property, then you've got to look at the amount you put into a reno. If you need to do it because of your family situation, go nuts. Do you know what I mean? But look at it. You've got to get that much you spend back in bank panel valuation to just break even on that property, as opposed to using that and putting it into another property, which might be worth $500,000, and you've got $500,000 in the market, which is going to go up in value. So if it's wealth creation you want, get another investment property. If it's family lifestyle and that's what you want to do, go nuts and renovate it. So hopefully that crystallises it. All right. What have we got? I'm just punch up here. Doris has asked, one of OpenCorp's principles is to acquire property that are X kilometres from the city centre. Given this pandemic has changed the way we view and need to go into the office, and less people need to be near the city centre, has this changed? See more to expand that OpenCorp's view. Really good question, Doris. The book, My Foyer, the Property Investor, has got additions.
Where'd you pull that out of?
It was literally under a pile of papers there. I've got a selection of them over here if you need. So
Got one in every room of the house just in case.
I've always got one close at hand. I go running in the morning and I've got one in the back pocket. The book, yes, it talks about buying from and looking at the distance from the CBD into the outer suburbs and and that distance, looking along that distance for land tracks. So there's a strategy involved there to buying. Strategy over the last good decade that we've been putting in place. So this was written about, 10 years ago, but we've fine-tuned that strategy to the point where we look at activity centres now. So it's a really easy concept to understand in the book. The new edition, which is with the publisher at the moment, getting fine-tuned, goes into the detail that Matt and Alan and I and Michael developed, which is looking the same principle, but looking at all the activity centres around each capital city. Will we expand away?
Yeah, so I think the key thing that was always the focus was that it was a proximity to jobs. And obviously the CBD is a really easy thing for people to recognise that there's a lot of jobs, a lot of white collar jobs there, which is great. Often that's where a lot of the higher income executives might work. But there's a lot of high income and wealthy business owners as well that live and work in the suburbs, and particularly around activity centres as well. And so we kind of, there was obviously a lot of nuance that the early version of the book wasn't picking up. So now what we're talking about is we look at the number of jobs within a close proximity, as in an easy commute from any suburb that we're looking at. So and that ties into the state government strategies of decentralising services, of all councils now when they are going through the planning scheme to create new suburbs, they have to identify how many jobs they're going to create and retain in that local government area. And obviously there's a much higher focus on jobs in that catchment.
And we should dig it out. I think that was part of the 2030 plan or 2040 plan, whichever one it was, but it was something like 85 to 90% of people working within half an hour of where they live. So it's absolutely changed from being reliant on the CBD. And I guess maybe a segue to that, Matt, would be there's lots of talk at the moment about the CBD and people's changed working conditions. They're working from home now. And will that, I guess, evolve into people being less centralised, which I guess supports what Cam's been saying through his book for the last 10 years, because that was what we visualised happening based on lack of public transport and infrastructure in those areas. Do you think we'll fast track that? Is that something we're going to see more of in the near future?
Spot on. So already trend when you talk to real estate agents, there's more focus from buyers on home offices. Where are they going to be working? Is it going to have light? Is it going to be comfortable for them? Obviously, people less focused on being close to the, I guess, the access points towards the city. And to just put it in perspective, so Casey, which is one of the biggest growth areas in Australia at the moment,
Example,
7% of people in Casey work in the city. So there's obviously that 93% are elsewhere, and the vast majority are within 3 LGAs that surround Casey. So already that's obviously something that's been trending that way, and absolutely we expect that to happen more and more. There's obviously reports that you're reading all the time at the moment of people who are, I guess, moving away from cities, not just in Australia, but internationally as well, and more people moving to suburban precincts where there's more green space and walking tracks. And if we're going to be spending more time at home, and not necessarily just because we're in lockdown, but there's obviously a lot of people who want to continue to work from home at least.
And we all spend a fair chunk of our day in Zoom meetings at the moment, and a lot of the corporates you're talking to are saying that they're completely restructuring their work-life balance going forward.
Yes,
It might be a day, 2 days in the office, the rest of it will be out in the suburbs or where they live, which draws you back to those activity centres, and that then makes businesses around there grow. There's more expenditure on lunches or restaurants or those things in those areas, and that just bolsters them along. So in terms of, I guess, what you talked about 10 years ago, Cam, with the activity centres, maybe it was foresight, I don't know what it was there, but...
they were planning them out, but Matt and I
absolutely
at the time analysing, the government was planning them out and rolling them out at that stage. We were just watching the jobs decentralise, and that was, I mean, if you look, Melbourne's a classic example. Casey, that Matt's just used, was probably the prime example through Melbourne, when $1 billion was spent through that, Central Dandenong and all the ATO, and government jobs moved out there. So I think it's just going to ram that a little bit faster. So a very good question, Doris. Adrian, thanks for joining us. Cam, I heard you on a podcast with the South Metro Junior Footy League talking about community fund. What is it? Also, you were talking about mental health, but I missed the end. Can you fill us in? Can do. So the South Metro Junior Footy League had an initiative, Sarah from the South Metro Junior Footy League. We were talking to her about different ways we can improve. And this goes back to probably something that Matt and Alan Michael and I believe in, that, and not blowing trumpets as far as, you know, what we do for the community, but one thing that we value in the community, and each of us come from sporting backgrounds, and I think gave us a good foundation in ourselves as people, and we value that for our kids, that kids being involved in sport keeps them out of trouble, and that's really what it did for me. Growing in a country town, and when I came to the city, being involved in sport, continually being involved in team sport and coaching now, watching kids stay out of trouble is really important to us. So we support maybe 40 different junior footy teams with sponsorships. And the South Metro Junior Footy League had this absolute brainwave, which is revolutionary. Nothing like it in the world that I know of.
Vision. It was their vision, yeah.
It was their vision, and we made it a reality. So OpenCorp and South Metro Junior Footy League got together and we made it a reality. What we want to do is raise $1 million per year for the kids to make footy free for the whole league. So you can imagine the additional kids you can get in if you can reduce the cost of sport. And the way you bring those kids in, they stay out of trouble, and Australia becomes a better place because they're involved in the community. They get that team ethic. So, the community fund is fantastic. And the reason I'll talk about it, and we put $100,000 into it each year for the next 3 years. And so we put our money where the mouth is. And the reason I say that is to challenge any other business to get involved in it. There's two economies at the moment. People are struggling, and I really feel for them. And those that are doing okay, those that are doing okay should still be doing good for the community. So that was what the South Metro Community Fund is. And mental health, I was doing a podcast with Cam Watts from the South Metro Junior Footy League, and he asked about mental health and finance. And what I talked about was, I think a lot of people struggle, and there's no Band-Aid solution for mental health. Are You Okay? I think is a great initiative, especially at the moment. One of our consultants today. What's that?
Is that today? Are you okay, Dad?
Yeah, Are You Okay? Yeah, fantastic initiative. My daughter's school got involved in it. It's awesome. And it was really poignant because we've had team members in our work whose family has suffered from mental health. Today, one of our contractors told me he didn't get back to me on some stuff that I did yesterday, and he called me and apologised, and he said his brother-in-law had committed suicide. So really tough times out there for people at the moment. But what I talked about with mental health, and when the only advice I could give to assist people, because everyone's different, is that a lot of mental health comes from a pressure of finance. It's one of the core things. Pressure of finance starts to create, or if you can take that away, is pressure of finance. So we talk through unpacking mental health by doing basic things, creating budgets, having a clear understanding of where your money's going, setting yourself small goals about where you need to be. So once you've got clarity around finance, even if it's not a good situation, it relaxes you a bit. So that was what the mental health discussion we had anyway, but thank you for, I'm glad you caught the podcast anyway. All right, we shall move on, but I think Are You Okay is a ripper initiative. Nathan, will setting up a trust protect me from a chick taking all my hard-earned money? Oh, well, that's, well, why don't you be nice to the chick and then she won't take your hard-earned money. But Matt, you want to talk about trusts for a minute, or Al, one of you guys?
I'll leave it to Al.
So just ask the question again. I'm just
Okay.
worried he doesn't trust. They don't trust each other first. Problem.
I'm reading it live, and I just the way. Yeah. All right. Will setting up a trust protect me from a chick taking all my hard-earned money? Is what Nathan said. A chick. Yeah, chick. That's right. Okay. Girls or women nowadays, Nath? Not the 1980s anymore, but anyway.
Or partner.
Yeah, I don't want to go into
Partner?
too much. My understanding is no.
All right, basically, if you've got a relationship with someone, unless you've got a prenuptial agreement in place, they have a good right to what you own. So a trust's not going to protect you. A prenuptial agreement will. Is that pretty straightforward, Lou? Yeah. All right.
Just find a different girl.
Yes. It's funny though. Some girls have got more money than guys when they go into relationships. So, Jane McCallum. Building a house from 1 to 1 versus stay renting and purchase. Two thirds. To purchase 2/3 for investment property only, guys' thoughts. Made the mistake of selling 2 investments 5 years ago. So you need to get my head around that. building a house for one-to-one versus staying, renting and purchasing 2/3 for investment purpose only. Guys, thoughts? You read that?
I don't know.
I'm not sure of the one-to-one. I'm not 100% sure of one-to-one and purchase 2/3 for investment property purchase only. Guys, thoughts?
Let's use it and talk about it maybe in a different way then. So we talk at times that the best time to buy property is as soon as you can buy a property. And sometimes that's on your own, and sometimes with a partner, and sometimes it can be with a brother. So I guess to use that, what she's saying there, if it's something she can't afford on her own, Matt and I bought our first property together, which we owned for 20 years. We built a portfolio together off the back of that. I'm calling it a fund, Matt calls it a portfolio. But we added, every time we had the equity, we'd add to that portfolio over that period of time. I guess the difference would have been, and in our first year to 2 years, we had really strong growth in that first property. If we were sitting there waiting for each other independently to be able to afford it, we probably would have missed the growth, and it makes it that much harder to get into the market. Because as the property grows, your deposit level also grows, and when the market's moving, you're not catching up, you're not even treading water. So if the question's around, is she better to go and partner with someone and buy one? If that's a choice as opposed to just renting and doing nothing, absolutely find a partner to do it with and get in there and do something.
Yeah, and if that's not the question, feel free to email me, cam@opencorp.com.au, Jane, and I can nut through it with you. That's all right.
I just think, sorry, just one more thing on that. And I think there's a lot of good accountants and also conveyancers or solicitors can put together pretty simple one-page agreements, if like in terms of a partnership or a buy-sell agreement. Because I guess that's the key thing. When Al and I bought our first property together, we absolutely were on the same page, knew what we wanted to do, and we were long-term holders of that property. Going into it with a friend and your life circumstances might change in the future. I guess just being clear up front on how you're going to deal with changes in circumstance, whether it's one person buys out the other or you both just agree you're going to sell, then yeah, that's the key thing. But it's not hard, as I said. It's a one pager.
Hey Matt, there's two ways. Then there's tenants in common and tenant and. Do you know what I'm talking about there? There's two ways you can structure a partnership purchasing a property.
Yeah. And
one's better than the other, but is that right with tenants in common?
It's been a long time since we bought our properties together, and I haven't.
Was it 1988?
Oh, no, I'll put my hand up. We had it wrong. Like we did it the wrong way. Yeah. So we didn't find out till later.
We went in joint ownership as opposed to tenants in common.
I think that's something like that.
And it means that I think under joint ownership, you're taking responsibility for the other person's obligations.
Yeah. So just get the right advice on it. There's two ways to do it. Get the same outcome, but they're just structured slightly differently in terms of how they go on the title.
Matt has sent through an absolute ripping question. This is what I think about, mate. This is what I love getting into the data about. And this is what Matt and I'll live and breathe for too. I'll spike this one up to you, Louis, because we've been talking about it a bit. Have the capital city market cycles changed or even been delayed? What's a catch-up period coming because of COVID?
Catch-up period because of COVID. All right, let's
unhinge it a bit.
Yeah, let's talk about cycles. Cycles have absolutely changed. I mean, I'm not as strong a believer in the fixed 7-year cycle that we were taught and told about 25 years ago. And I even saw something the other day about the share market. Some expert in America was talking about the 60-year cycle and what's coming in the future as higher valuations for. I was like, you can't honestly believe that a 60-year cycle can run and be repeated forever when society changes so much.
There's a term clutching at straws. That's what's happening right now.
So anyway, I've never just believed that cycles happen in a fixed time because of the time. There's other things that are influencing it. And certainly since 2000, I guess the peaks and troughs have happened a little bit more frequently. And all the capital cities have gone at different timeframes. So you can't draw a 7-year cycle or a 9-year cycle and say it's common across all cities. Some cities will go for 3 years. Like you look at Perth, will go for 3 years with almost no growth or negative growth. Generally will then go very hard for the next 2 years and then stop growing for the next 3 to 5. Sydney has really long cycles. Melbourne has longer cycles, and that's largely because of our population base. It takes a long time to turn a ship that, I like to visualize a big, heavy ship in the ocean, and it's very hard to turn it around when you've got such a big population. That in the city, that's what happens, because turning the supply on and turning it off doesn't react at exactly the same time to the market demand. So I guess in terms of cycles, as I said, I don't prescribe to the theory of just like standardized
definite cycle. Yeah.
What we do look at is what are the drivers of change? What's driving supply? What's driving demand? And if we think about COVID and think about COVID as suppressed demand. So for 3 months between March and June in most cities around Australia, there was absolutely suppressed demand. And when that came off, even I guess in Melbourne and Sydney, in June, we saw this big spike of activity. And if you think about that demand, it's not just in housing markets, it's almost everything. Like right now, you can't have court cases. So there's a backlog of legal cases waiting until we're out of lockdown to have. There's people who haven't been able to get a haircut, Al. People who have deferred elective surgery. There's people who have deferred buying cars. And obviously there's people who have deferred buying new houses. So there's going to be a big rush of people coming to the market right across the economy as we come out of lockdown. And we saw that in Brisbane, we've seen it in Perth, we've seen it in other cities that have gotten comfortably out of their lockdowns and seen better health responses. And that created momentum. So you look at some of those cities now around Australia that have really captured that momentum and are still going really strong. Obviously, Melbourne got pushed back into lockdown, which kind of just dropped down momentum. By the time we come out, will be pretty much the end of October before people are allowed to actually go and inspect properties by appointment. November's normally our peak selling season. I guess we'd expect that there's going to be very few properties coming to market in November. Obviously, there might be some people who have to sell, but it's going to mean that there's increasing demand at a time when there's very little supply. So talked about strangling markets in the land market and drip feeding the market. Well, that's what's going to be happening in the established house market late this year. We'd expect that probably early next year, there'll be a little bit more supply coming onto the market. But by that stage, there's almost a year's worth of demand that's been building in Melbourne, waiting to buy. So I guess in terms of how that plays out in the cycle is decoupled from anything that you would have thought in the past. It's going to be driven by, I guess, the catch up in demand, creating momentum with very low interest rates. And then it's the low interest rate that starts to define, I guess, where the next cycle will be, as well as infrastructure spending and how our economy, I guess, performs over the next few years.
Yeah, there's also, with the pent up demand, is the issue of we've already had a housing shortage. We've got limited land supply due to the urban growth boundary, and we haven't been able to get buildings complete, started. So not only is there a pent up demand, we're not feeding the market that's already there. So I'm bullish about it. I usually don't do short-term price predictions, but I do like what's going to occur post-COVID.
Well, if I can just add to that question around, is it just Sydney moves, then Melbourne moves, then Brisbane moves, then Perth moves? Well, as Matt said, no, it's not just a linear time frame where those things go. Well, 6 months later, we'll kick off there. But looking really closely at the Brisbane cycles, the last couple of times they've really spiked. What drove them was interstate migration. And what we're seeing now is people desperately trying to get out of Melbourne and go into Brisbane because, one, there's wage parity. You get the same job in Brisbane or same wage in Brisbane and in Melbourne, but you sell a house in Melbourne and go to Brisbane and you've got much more money to spend. And coupled with the fact of how this pandemic's been handled, I think it's been a trigger for lots of people. Are you waving at me, Matt?
And I'm
a trigger for lots of people to say, we want to move now. And they're starting to see that migration and their market's really tightened up.
Yeah, so talking to a consultant, an architect who's moving up to Brisbane in 3 weeks' time, I was chatting to him 2 days ago and he said,
Kai. It's a Kai.
Yeah, he's been dealing with removalists. He's spoken to a lot of the different removalist companies to work out how they can get up because it's just so busy. He said the feedback from every removalist who works on interstate freight said they've never been busier for people moving from Melbourne to Brisbane. So, and I think we're seeing that in vacancy rates in Brisbane right now, trending down really strongly, despite the fact that obviously there's been a lot of talk about closed borders and no immigration. There's obviously a shrinking supply of houses up there.
We've had nearly 4 years of delayed cycles, just to come back to what Matt asked, so 2017, the markets all started to move. Melbourne and Sydney had a cranking market, and Brisbane had really started to get some momentum. Some land sales really started to take off there. Vacancy rate was coming down in specific areas. Because of Sydney's buying at the back end of their market, the speculative buying, there was 60% of, I think it was February 17, my dates are right, 60% of the sales were interest-only loans. So what that meant was, and this is where APRA stepped in and crippled the lending industry by basically putting the brakes on, by increasing the requirement of cash buffers to on a new applicants. What that meant was that they wanted to slow the Sydney market down. 60% of the buyers are investors. They're getting into the back end of the market. And obviously, at the back end of any market, we know there's going to be a correction. We do know that about cycles. So people were buying right at the peak of the market, and all those people were just speculating and they were going to take a hit. So APRA pulled the brakes on the lending. That then slowed down Melbourne and definitely slowed down Brisbane. So those two markets were put on halt. 3 years after that, go Louis.
No, I was waiting till you finished. It's all right.
Yeah, no, that's all right. 3 years after that.
You've been such a dork for.
It's my palate. And I'm bidding it.
Brother, your brother, you can tease him. It's all right. Once the brakes had come off the lending, that basically the market started to pick up again, and we saw some huge growth at the back end of 19, leading into February. Over that Christmas, I was going fantastic, game on again on most capital city markets, and then this thing called COVID came along, which really put the brakes on. So pent up demand, yes, we're waiting for some cycles to move.
Before Matt jumps in after his hand raising, I will say though, as someone who's heavily invested in Brisbane for the last few years, I'm going to bed at night in the best REM sleep of my life, knowing that growth is going to come into that market in the next 6 to 12 months.
I know, I've been high-fiving Felicity going, here she goes, ready to blow. And I don't like doing short-term predictions. So,
there was another time in Australia where the central bank or the government artificially constrained housing lending. You guys across this one?
Is it the time of thinking when they jacked interest rates, when they had that as a lever?
So in the 1950s, Australia had come into the 1950s, 120% debt to GDP. Obviously, huge government debt after World War II. They increased immigration, so there was a huge increase in demand. There was interest rates were pretty much stuck at around 5%, so they weren't moving back then. It wasn't flexible the way that they adjusted on a monthly basis now, and prices started to go up. Unemployment was down at 2%, and obviously to control capital growth, because it had started to just creep up so quickly, and control inflation, they started to put controls on how much people could borrow to buy any house. And I wouldn't be surprised. I know we've spent a lot of time looking at this, that while there's obviously a lot of talk about what's going to happen with immigration post this period, the history book would tell us that when government has high debt, they want to increase the size of the economy relatively quickly so that it shrinks the debt relative to the size of the economy. And to do that, they have to open up the gates and increase immigration. Now, obviously, they're not going to do that while there's still a health crisis. But once we get beyond that, then I think that there's a fairly good chance that Australia will see either back to what we had in terms of immigration numbers or even higher moving forward.
There you go, Matt. Hopefully that answers your question. Oh, here we go.
Nice to ask a question.
Like
No, answer.
On the screen,
hold your hand up.
Our names have our surname, and you've just got Cam. I've got Alistair Lewis, and he's got Matthew Lewis, and
he's like Beyonce.
Beyonce, yeah. I've got one name. Yeah. I did have it. We had a family Zoom, and I logged on, and Gus had changed my name to Pooh Face, so you can change it. So,
I have to check that.
Shamila, in Cam's book, he talks about living off equity. However, with stricter banking regulations, is this still possible, or should we move into reducing value to loan ratio, i.e. P&I type loans? If that's the case, should we start looking into this before scheduled retirement goal? It is a ripper question, something which we have talked about in great depth, even as recent as yesterday. Louis and I were talking about it with Michael. Individual circumstance, to try and give you a question over this format would be very difficult. and I don't want to give financial advice whatsoever. If you email either Cam at OpenCorp or Michael at opencorp.com.au, Michael will be the best person to work through. But what usually comes into play with a lot of our clients is when we work through the exit strategy, it's usually a combination of the exit strategies we talk about. You're right, living off equity is becoming harder and harder with the banks. There's no doubt about that. It usually requires a pay down of debt. Pay down of debt is easier to do by selling investment properties, so letting them double in value, selling down, than it is by paying principal. So much easier. So paying debt down with huge growth as opposed to hours worked is the way to go. But each individual's very specific. So emails through and I can get Michael and his team to work the details.
I'll just probably add something to that, Cam. So we talk a lot about the accumulation phase where you're purchasing properties, and then we talk about the growth phase of the portfolio.
Yeah.
So the faster you can go through accumulation phase, pick up your portfolio and let it sit there and ride out, the more equity you've got at the very back end of it.
Yeah.
With that said, depending on the bank, there's different metrics they look at. So they would consider someone a professional investor and lend them a 65% of the portfolio, subject to what their rental coverage is. So if you've bought your portfolio in year one and added 10 properties to it, and 30 years later you go and talk to the bank, absolutely you can gear the thing up and keep gearing it up because you have the coverage and the metrics the bank wants. But everyone's, and just to, I guess, back up your point there, everyone's situation is very different. And there's one of the 4 exit strategies you've talked about in the book. Some do a multiple of a few of them, some pick one that works for them, but it's going to come down to who you are and what you're trying to achieve at the back end of that. Yeah,
very, very, very true. So hopefully that gives you...
Mate, do you want to talk about, and the example we went through of our exit, and just to test out the different exits on that, I guess, fund that I'm calling it.
That's your dual portfolio, is that what you're talking about? Oh, sorry, guys.
Yeah, is that what we're talking about, Matt? Or not really relevant to this?
Yeah, no, it is. And I think Cam and I, we're going to have you on the podcast next week and go through that in a bit of detail. So yeah, if you guys want to tune into that, we can.
Sure. Right, just make sure I've got the most. Shamila, good question. Daniel, when the market's not yet going, we're saving like crazy trying to get extra funds for a deposit for investment number 3. Awesome to see you got that far. Other banks now providing higher percentage loans at the moment, i.e. 90 or even 100%. I believe the banks are offering a higher loan to value ratio. I think there is one bank going to 95%. Louis, Al, you guys are aware of that? Yeah. Email through Cam at OpenCorp and I can put you under the team and push you in the right direction there if you like. So, but good to see you kicking into number 3. Awesome. Nick, hey guys, with the situation surrounding COVID, do you see it creating the perfect storm for property price growth in the next 2 to 3 years post the pandemic? I think we nearly covered that with Matt. The perfect storm requires a number of things to occur to really crank the markets. The government stimulus is probably the most important. As Louis said, and we've used the term, ScoMo at the start of this, used the term building a bridge to get over COVID. Now we've been through it and the uncertainty is becoming normal. We're getting into a new normal. Matt, Al, Michael and I coined the phrase putting the economy on idle. And that's the way we talk to our clients when we were doing initial over the first 6 weeks, doing weekly videos out to them. And the way we discussed the policy changes with our team members in our weekly meetings, when we're sort of looking through the policy, talking through what it meant at a personal level for our clients, for markets, for the world. And I think, as Matt said, at the moment, the government's putting little bits of stimulus in, just a little bit of building grant, just to keep things ticking along, and a little bit of JobKeeper and JobSeeker. And the numbers sound astronomical, but it's really a blip in the GDP equation, the percentage of GDP, debt to GDP. So the perfect storm comes when the government really cranks that stimulus. And when we talk about idle, Matt and I have talked about it, and Matt gave a good analogy to it. It's like a car sitting at the traffic lights, and to get the economy going again, you've got to get up this next hill, the crest of the next hill. Once you get up to the crest, you can come down the other side and coast down it. The economy's running on its own by then. But to crank up and get up over the hill needs a bit of fuel, and that's what the government's going to put in. Louis, if you want to get more technical than that.
No, I just wanted to, just in terms of what you would consider a perfect storm, and as you've touched on, there's stimulus, there's low interest rates as well. But I guess the other thing that's happened in the last few weeks, the US Federal Reserve came out with a fairly big policy shift. Obviously, central banks have targeted a CPI or inflation band of 2 to 3% for the last, I don't know, as long as I've been alive, I'm pretty sure. They haven't met that since the GFC. So the US economy's been inflating at less than 1.5% on average for the last 10 years. So the Federal Reserve has said, you know, we're behind where we wanted to be. So we're going to let the economy run hotter for longer. And that means if we end up at 3 or 4% CPI, we're just going to let it keep going until we catch up on the lost growth. And that's obviously a way that they're going to help to get their debt to GDP down, because it means their economy grows more because prices are inflating. But the Federal Reserve has created more liquidity for the global economy than any other central bank. And when money gets put into the US economy, doesn't stay in the US economy, it filters out to all of the other economies, and Australia is a beneficiary of that as well. So absolutely, we think that liquidity is also going to be flowing into asset prices, not just in the share market, but also in real property prices as well. And we saw that over the last 10 years in commercial property. It was largely the squeezing in commercial property yields, which pushed up values, was driven by the amount of capital in the system coming out of the US.
And I think the number they're talking about, the debt that Australia is bringing in, sounds, as Cam said, astronomical, but it's really not. It is significant, but in the grand scheme of things, not really. But if we talk about that in terms of how we as property investors look at gearing, I think they're talking that our debt to GDP is 40 or 43% when it maxes out. Other countries around the world are sitting at 110%. So if that helps people to consider it in a term they understand, you look at the LVR on your property. If you're at 80%, the bank's okay. If you're 110, not. And Australia's going to be sitting at 43 versus the rest of the world much higher. So it's a lot of debt we're taking on, but we're coming from a very low base.
Yeah, and as Matt did in his crazy propeller head analytical research at the start of COVID, looking back at the GDP, and you mentioned it before, around the war at 120%, and we didn't pay down that debt. It's like a house. You don't pay down, as Al said before, if you've got a loan to value ratio of 80%, you don't pay down the debt to get the loan to value ratio down. Instead, you let the asset grow in value, and that reduces the cost. And that's what we did after the war. And that's what we'll do after this. You know, we're not going to pay down the debt. We're just going to let our gross domestic product, the asset of that, grow in value, and that reduces the debt.
Yeah, we'll hear lots of talk about getting back to surplus. And again, a surplus doesn't mean that the debt is getting down to zero. A surplus just means that we're servicing all of our expenses plus the interest on the debt, and we're breaking even. Or
you're not negative gearing anymore.
Yeah, that's right. Yeah, that's a good way to look at it. So yeah, you've moved out of negative gearing and you've got a positive cash flow, but it doesn't mean that you're paying down the debt fast.
You haven't paid it all off. You're paying it off.
Yep.
Yeah. Jane has crystallised her question. It was, should she buy a $1.1 million property versus 2 or 3 $1.1 million home versus
we're way off
properties? Yeah, we're way off. Sorry, Jane. We really apologise for that. If you email me, Jane, at cam@opencorp.com.au, Michael Beresford, who is one of our business partners, has done an amazing video. If you're at the stage of life where you just want to buy a property and a home and that's it, and you want to pay that off and you're comfortable paying it off over 25, 30 years, that's fine. If wealth is what you're looking for, each of us did it. We rented for a long period of time, or we built a property portfolio. But Michael, side-by-side comparison of renting versus buying, specifically what you're talking about is rent vesting. So I prefer...
Is the question, Cam, 1.1 investment property or 3?
No, 1.1 home.
Live in, yeah.
Live in, or rent and buy 2 or 3 investment properties. She said she sold a few investment properties and regrets it, 5 years ago, which one thing we all regret is selling a property if we've got rid of it. So yeah, shoot us through an email at cam@opencorp and I'll send you through the link, because that does a perfect side-by-side example of rent vesting.
Can you give a snippet on how it covers it?
Well, basically it just goes through and explains the growth you'll have on an individual home versus, and I can't remember the numbers now, mate, so it's probably about 4 years I watched the video myself, but it breaks down even to the point of going how many thousands of dollars based on each property you purchase, the growth rate of each, how much money you can use to buy the next property, how you can fund a lifestyle. It even factors in renting a ridiculous house, so making sure you're living in a place which would be better than your $1.1 million house. So it's pretty biased to a good lifestyle and building wealth at the same point in time. So thanks for clarifying, Jane. Hopefully I can give you a bit more details there. Johnny Jess over in Singapore, living the dream over there. Johnny, how are you, bud? Good to hear from you. Hope you and Amy and the kids are going well. Nathan, I've seen the graphic you guys talk about on supply and demand and when you want to be buying. It's in Cam's book, but finding out where the supply and demand is at a point in time is difficult. I'm meant to be looking at city council websites and looking at where they're planned to the suburbs, or is there a real statistic on this? Sorry for the silly question. No question silly, Nathan. Believe me.
Good question.
I used to be the person who asked all the silly questions, and I soon became the person with all the answers. So there's no silly question, mate. That's all about learning. The question on the book, and Matt was actually heavily responsible for developing this graphic. It's called the developer's activity chain. So, and what it was trying to illustrate, Nathan, was not the point of picking the bottom of the market. So it wasn't telling you when to invest. It was telling you when not to invest. And I think that's what people investing. It's not about picking the ultimate investment property. Because if you're waiting around trying to pick the ultimate investment property, most people miss out on it and wait too long. And if you pick lots of reasonably well picked, investment properties and group them together. So it's about not picking a loser. So that graphic is actually teaching you to identify when the point is when it's a danger point, which is right at the peak of the market. Like I talked about with Sydney before, looking at things that you could quite easily from someone who understands the data to understand that if 60% of the loans are interest-only loans in a hot market, then that market is about to tank. And that's what that graphic's about. Lou, is that pretty much the...
Yeah, and I think just coming to, it was Nathan's question, wasn't it? Yeah.
It was Nathan Ripper question.
Yeah, it was. And it sounds like you're doing a lot of investigation, Nathan, which is great. So it is a challenge. You can obviously, like there are tools like RP data that you can buy a license for that allow you to see how many property transactions are occurring in any given suburb. So it's easy to see, I guess, sales activity. The hardest thing, and obviously we've got a team of people who look at this, but the hardest thing is working out the current supply. And I guess I'll just clarify a definition. So current supply is how much stock can be put to the market today. And then there's underlying supply, which is supply that is there that could be developed in the future. So again, if you're looking at a suburb that's got a structure plan, so normally when a suburb's going through planning, the council and the state government and all the landowners agree on what the structure plan is going to be and how many dwellings can be delivered within that precinct. So within that structure plan, there might be capacity for 7,000 homes to be built. There's a really good case in point in Greenvale Central, which we had some land in which we developed, but also there was a number of other small developers in there as well. And some of our clients bought in that precinct and they're still buying in there. It's been a good one. All of the land parcels were about 2 hectares each, which meant that every single owner in that precinct had only a small amount of land that couldn't justify spending money on infrastructure. So they had to wait for the land parcel next to them to get developed. Then they have their turn. And then when that one goes, then the next person has their turn. So that meant that obviously the current supply at any point in time is constrained. It's only a small amount of land coming to market versus the underlying supply, which is that there's still another 2,000 lots to be developed in that precinct, but it's going to take better than 10 years to develop all of that land. And to really understand that, without having access to land ownership data and boots on the ground, talking to council, talking to consultants is really challenging. Probably the next best thing that you can do is also looking at aerial maps and looking at the aerial map, comparing that to the structure plan to see how much of the structure planning area has already been developed, and also identifying how much of the structure planning area is set aside for residential versus commercial, and where are the parks versus an industrial and so on. And obviously a lot of land at the moment gets set aside in some precincts for green space, waterway corridors. So anyway, I think you're on the right track, but yeah. I know how hard it is to actually get the true amount of supply that can come through, because I know if it wasn't for us having networks and contacts, the amount of work we'd have to do to get it.
And I think a key thing for me, and if we use Cam's Melbourne tooth that he used to like to draw, it's about understanding the supply between where you're looking and the capital city. Or the activity center. Supply coming out behind you and you go, well, there's 15 years supply out behind me. That's okay. That's what the supply means for you at the current time. And if there's a big abundance of it in front of you, that's a problem. If there's not, then it's not so much of a problem. So there's a few boxes to tick before you get to knowing specifically in that council area what's going to be happening.
Good question though. Rowan has, what's the trigger that is used by the OpenCorp team to decide it is time to review a client's position and go again? Is it simply time-based or related to movements in the local market? Thanks. Good question, Rowan. It's probably taken me, I reckon, 5 years in the making. We're just about to move all of our client reviews online. So we've created a community portal for everyone. So we're going into the dark ages. We obviously use a lot of technology through the business, but creating an online portal which is developed and it's just getting fine-tuned before it's rolled out. It's already have a sample of clients go through it and just be tested. And basically that houses everyone. So we set in your goals, timeframes, there's review dates, but it also automatically, so what Matt was talking about then on boots on the ground and really understanding what's going on in each area. He's got a team of full-timers in his acquisition team and analytics team that study that for him. So it's not that he just pulls a few reports from different areas and reviews it and makes it, throws the data to the bullseye. All of that research that goes into it. So the different property economic reports go into Matt's team. They look at it, that gets fed into our client's individual portfolio. So it updates on their type of property that they have. It will then identify if they've got equity growth. We then work with the client to see whether their lifestyle's changed. So it'll be on a time base and portfolio performance base. So there'll be two metrics on when we'll be saying for a client it's time to go again. Now that all hinges off the initial meetings we have with clients to say, what's your plan on where you want to get to and what time frame do you need to be duplicating? And so we match that, the availability of equity and income and making sure a client's lifestyle is not impacted against their goals of where their plan that they created brought to us wants to get them. But that is all going to be automated now. So we're excited about it. So yeah, there's two things. It's, are you ready to go again financially? And there'll be a regular time review anyway, just to update your position and ensure we're interacting with you. So hopefully that gives you an understanding, right? Mike Quinn, I think this is a loaded question, Mike. So you all happy with Dania Andrews? In these forums, mate, very much, regardless if I'd have a lot to say or not, and I'd say I'm not enjoying lockdown whatsoever. If it was a different forum, mate, I might have a fair bit to say, but I don't like talking politics in open forums. But good question, Mike.
Just had a dinner table conversation with the kids about always looking on the bright side of life. So I think I'll just stick with that.
Yeah. I get about 15 messages a day from Mike about how negative Dan Andrews' comments can get. So
yeah, I was joking with Felicity. Not that I even really consider it, but I was going, I think I'm nearly at the point to join the protest march, anti-lockdown march. I can't do this.
I thought we weren't doing politics.
I thought we weren't. No. There's points in the day where I go stir crazy, right? So yeah, social interaction is needed, which is when people talk about we're all going to work from home and everyone's going to be kumbaya over Zoom. I think it's bullshit. I'm desperate to get back to the office and talk to people. I can't handle this anymore. So let me out and let me go and back to the office.
Ham and I are running a daily competition on our iWatch Gilligill Burns, and there's some serious numbers getting smashed out on a daily basis by both of us.
Yeah, I'm knocking out 2,500 calories a day easy if I can. Yeah, so lots of walks. Anyway, thanks for that loaded question, Mike. Shamila, what's OpenCorp's Resi Fund about? Is it an investment vehicle that people can invest in beside the stock market? And if so, what's the performance since launch in estimation and estimated projections? It is a really good question. I try not to keep these forums as selling OpenCorp. I prefer to keep them as more of questions and answers. So it's not about us pushing our services or product, but since you asked, Shamila, Matt actually runs the Resi Fund in our funds management division. So Matt, the question is, what Resi Fund, what is it? It is a good option for transitioning to retirement, and what's the performance like and what's its estimated projections like? And I'm sure you'll say you can't say that.
It's hard to project, but we can obviously offer guidance. So since we launched in March of 2019, we've achieved an 11% return. And in fact, I think we picked up 1.2% just in the last month in the fund as well. So we have been performing well. We start, I think our first distribution is expected to go out in October. So we were building up the start of the portfolio over the last year, and now we're starting, now that we've got occupancy, we're starting to pay out distributions. We're forecasting about a 10% return per annum moving forward, and we've got some new acquisitions that we're about to progress further as well. So
with really the acquisition, maybe if I ask you, and that'll draw out the information, Louis. So with the fund itself, it owns or buys and holds residential property. Yeah.
It does pretty much what we did when we started out building our portfolios: buying, adding value, holding, taking the income, and obviously then using the equity growth to buy, add value, hold. The big difference is that it's got very low gearing, and we've got very low gearing because we designed it to suit people who, particularly people who are seeking to stay in the property market, but who have perhaps exited their own portfolios and want to generate more of a passive income. So obviously having lower gearing means that the income is more positive, but also that it's lower risk. And that means that we don't have the huge benefit you have if you gear something to 95% and it goes up by 10%, or you've tripled your money. We don't have that, but it obviously is more of a slow, steady, I guess, growth plus income for investors. And they get a share of everything, every asset that we buy in the fund.
And combined, so the new acquisition that you're talking about, with the properties it's already got in there, how many leases are within the fund? How many?
So we've currently got 9 tenants, and we'll have another 5 units of tenants within the next 3 months. By Christmas, we'd expect to have 14 and income generating properties, and
Another acquisition.
Another acquisition. So we should be sort of mid next year up around sort of 30 at least, probably more.
So 30, yeah. So and they're not apartments, but they're, and you mentioned,
no.
Well, we say units, but they're basically individual houses.
How many people are paying rent to us? Yeah.
And I see one of the key benefits of it. And as I talked about, Matt and I had a fund portfolio. Cam and I, we've had our own separately. I've got my own. And at certain points, each of those is come up against debt servicing issues. So the bank's got 2 key metrics. They're LVRs in loan to value ratio, DSR being the debt service ratio. The beauty of Resi Fund is it can keep growing. So with the fund that Matt and I had earlier, we acquired some properties. We maxed out what the banks would lend us. So we moved on to do different things. The beauty of Resi Fund is it can keep growing, because it's not going to come up against that hurdle due to the way the banks are assessing the income into the fund through the rents.
It's a registered fund.
Anything to add?
I'd probably just quickly, Louis, if you can just talk really quickly about the regulation of the fund, compliance of the fund, and that we've got an Australian Financial Services licence. So can only talk specifically about the fund, can't talk about whether it suits anyone individually.
Absolutely. I can tell you sort of how we designed it, like I did earlier, and I think you've covered most of it just then, Cam, in
That's all right.
what you wanted me to say. But yeah, I mean, we've tried to develop it on the, I guess, the highest, controls and governance framework to make sure that it's delivered and managed in the best way possible. We've got some really good people in our independent investment committee, as well as our independent compliance committee. And we're all, I guess, really excited about it, but heavily focused on delivering great customer outcomes.
All right. I think hopefully that answers the question. Reza has a question. Isn't the right time to invest in property, or better to wait? Some rumours saying 30% drop coming soon. Reza, the old saying, which Matt and Elle's dad told me many years ago when I asked the same question, is it the right time to buy? When's the right time to buy property? His answer was 20 years ago. If not, the second best time is right now. So saying that, if you can buy a property and hold it, then there's no risk to your investment. And over the long term, it'll go up in value. Matt's raising his hand. You're going to talk about where the headlines would come from of the 30% drop in market?
I was just going to say, absolutely agree. Somewhere in Australia, prices might drop 30%, and all of those pundits will say, look at us, we got it right. And it will be the back of beyond somewhere.
Or apartment market, or the top end blue chip affluent area.
But certainly the Australian housing market as a whole, and capital city markets generally, are not going to see that. And look, we try to stay away from, firm forecasts, but because we know that life will change and there's things that get thrown at you that you're not expecting, like we've just experienced this year. But I think the probability of that happening, when what we're seeing in live, I guess, experience today with different markets around Australia in a land rush, where agents that we're talking to in the established housing markets are seeing huge increases in demand, and sort of it's very hard to.
That's while COVID's happening.
Yeah, absolutely.
Yeah. So yes, there'll be. We've talked about it in other forums that we've already seen 20% drops in median house price. That's primarily because the affluent areas, and we've named them in previous reports we've put out, which affluent areas saw the drops, or the median came down because there was less sales at that top end of the market, which shifts the middle price. The media get onto that and creates a fantastic headline. The apartment market has definitely seen a bit of a hit as well, because people want to get out of apartments, congested, they want to move to outer ring. We've talked in detail with Tim Lawless, who was on one of our webinars, and we interviewed Tim and we went through the detail about the apartment market and why the apartments market's getting hit. And primarily it's getting hit because people want to move away from it, and because student accommodation, or students or new people to Australia, I think 80% of them live in apartment style living for the first couple of years when they come to Australia, until they ingrain themselves in our culture and start to move out to the burbs. So yes, we're going to see that sort of drop. If you're buying in well-chosen areas with tight supply, you're not going to see those sort of drops. Or probably a better way to put it is, I'm still investing now, and so is my team and our clients. So hopefully that answers your question. Leonie, what are your thoughts on having positive geared investment property compared to negative? Just finished building a duplex in Queensland. When should you invest again? Ripper question. I've never bowed down, I suppose, to or bought into the positive or negative argument too much. There's definitely companies out there that sell strongly on positive geared property, or buy because of negative gearing, because they can wrap a good story about why that's the winner. We used to do a knockout round in some of our workshops with clients, where we'd ask the question, and then we'd work through both scenarios, and then we'd work through a scenario where you get both. So we like areas with tight infill, medium density housing in capital cities that get really strong long-term growth. But after a few years, and you can take advantage of negative gearing for the first few years, while you've got that depreciation going on, until the property rental amounts go up and the property becomes positively geared. So I'd say be greedy and expect both. A duplex is, and Al and I own a number of duplexes. I think we own 22 of them or something like that, and we're selling out of them currently, because while they give a good income, they don't provide the growth that we're looking for in our portfolio. So but each person's different. We bought those a long time ago, and they were a side, sort of portfolio that we built up with some commercial property and a few different. So it was a different style of portfolio. When you're talking about building a strong portfolio that's guaranteed safe, that's going to get you there, they'll be looking at medium density housing and infill areas that are negative geared to start, but become positively geared. Because think about the basics of negative gearing. Giving $1 away to make 50 cents back is not a smart investment strategy. So the whole concept of negative gearing is long-term is not right. You want to become cash flow positive. Anything else?
Well, the second part of the question, as soon as you can buy them.
As soon as you can buy. Yeah.
Just in terms of negative gearing as well, you can be cash flow positive and negatively geared. That's
True.
I think something else, the nuance that a lot of people miss out on is, right now when interest rates are 2.5% and you're generating on a property 4 or 5% gross yields, you should be cash flow positive, but because of depreciation on your tax return, you're negatively geared. So you're getting the tax benefit even though you're putting money into your pocket every month anyway.
Yeah. If I just talk really quickly on two things, because I know I'll get this question, why you're selling out of your duplexes. The valuers, and the way we looked at duplexes were the same thing. We had a commercial portfolio, which we added duplexes in just because they were similar style. But the issue we had with them was the valuers see them as a very small part of the market. So they're hard to get that valuation continually to go up. And that's what we're struggling with to a degree. And that because the valuers see them like Quest Apartments or MRES type property, there's a small amount of people who are in the market to buy them. Saying that they might be great for your portfolio, so not talking it down. And the other thing, negative gearing, I think it's the old Harry Dent, that flog from the US, that his name? I'm sure it is, who bags our Australian, always says the Australian property market has for the last 20 years said we're in a bubble because he can't comprehend the difference between our value and our rental amounts. And the reason is we've got negative gearing. So we use negative gearing to spread and to make it more affordable for renters to live throughout our community, because we want our renters to live side by side with our owner occupiers, and then it gives good community, as opposed to America where they rental controlled housing. They call it the projects or ghettos. You know, we didn't want ghettos or the projects in Australia. We wanted people living in throughout. So that's why we created negative gearing. Government forgot about it in the 80s and reinstated it. But so hopefully that gives you a quick snapshot there. I think it's more than a quick snapshot. What do we got? Rowan, what's the main trigger used by OpenCorp team? Oh no, that's all right. I've jumped down. I think we've said that one. Pratik, how much do you guys charge for advice to purchase the next property? We charge about 2.5% of the property purchase price on each purchase. It's not going to make or break us one property purchase, but over 50, 60% thereabouts of our business comes from repeat and referral. So when we bring a client on, we want to ensure that they're buying 2, 3, 4, 5 properties. So over their lifetime, it's profitable for us and we win if they win. So the property goes up in value and we're doing our job because we picked the property well, and Matt's teams pick the property well and they've got that growth they need. They purchase again, we get our fee again. So hopefully that, and there's a huge amount of guarantees and assurances that are wrapped into that. So more than happy to go through that. Shoot us a direct message if you want detail. What do we got? Anne Lewison, I'm at the protest cam. Nice one, Anne. Good. Have you on board? Rowan, when the time comes to go again, is the equity in the owner property used a second time, or do you move the risk fully to the investment property? Is the equity on the owner? Right, so this I think is about finance structure and where to get your next deposit from. So Rowan's asked, is the equity in the primary place of resident used the second time, or do you move the risk to the investment property? The way brokers and banks like to set up loans, and once again, email through Cam at OpenCorp, and I can shoot you a link to a really good video that Michael, our business partner, has done on this, which explains structures and way you must have your portfolio finance in your portfolio structured to allow you to duplicate and keep you safe. Banks and brokers, because it's easy and it's safe for the bank, want to cross-collateralize. So they want you to use this property A, your home, as security for investment property 1 or 2 or 3. The way we set it up is we say to bank ABC, Westpac for example, Westpac, we're buying another property, but we're not using you for the investment property. We're going to take a line of credit or take an equity loan on the side here, and we disclose that, and then we use that for deposit over here on any other bank, doesn't matter. So we ensure there's a firewall between the two. That means that if anything happens to this property, they can't touch your own home. It's a lot more work for brokers and banks to do it that way, and they don't get paid anymore for it, the brokers, so they don't like to do it. They won't even tell you about it, most of them. Al runs a finance division, a team of brokers that specialise in doing that. So if you're looking at doing that, yeah, emails through.
I'll just quickly add to it, Cab, but I think the important thing is, let's assume someone's got 3 properties and they've all got up by this much. Use a bit of equity from each of them to get the next property. So it doesn't matter where it comes from, it's all deductible. If you borrow more against your own house and some against the investment properties, you're still in that deductibility, but you're buying the next property, you're getting the growth over the next 10 years of doubling value.
Yeah. Jimmy said, do you ever consider diversifying into commercial property or just focus on residential? We've owned commercial property. I think we still own commercial property. Al and I purchased property together in a previous business because we wanted to house the business there. When it comes to building a portfolio, I've heard a lot of people say over the time, do you build a residential portfolio and then build a commercial property portfolio like it's a sort of stepping stone? It's not the case. The reality is, to build wealth, initially when you're trying to build a portfolio, the best way to build wealth is to own the most amount of asset with the least amount of money out of your back pocket. So if you're looking at a $1 million purchase of a commercial property with the gearing required, you're going to require at least 300 grand to be putting into that to own that $1 million commercial property. Now, $1 million commercial property is going to be a milk park. So then you've got the issue of, first of all, to buy any commercial property, You need to know that the industry the owner's in safe. You need to be able to review their business financials. So you need to understand profit and loss statements, balance sheets, cash flow, understand their management team, what security they've got around it. And you've got a lot of other things that go on with commercial properties. But even that aside, if you can handle that, that's fine. What you need to compare is for 300 grand, how much asset can I hold? With commercial, it might be $1 million. With residential, it might be 2 million, thereabouts. So for the same amount of money out of your back pocket, you're holding double the asset. So even if commercial was to slightly beat residential in growth, which it doesn't over the long term, Matt's doing figures I think now, but no, it's all right. But that gives you the context of why residential, I'll always argue that it is safer, because you've got, in that instance, you might have 2 or 3 properties worth, 500, 600 grand each versus 1 property. So you've got 1 small business landlord compared to 3 stable residential tenants. You're holding 3/4 to 100% more asset than the commercial property, and you can pick and choose. So you've actually diversified more by having the residential property.
I think one other thing, just in terms of commercial as well, that historically commercial properties did generate a higher income relative to residential, but you can see over the last years the difference is squeezed. In fact, there's a lot of commercial properties paying less right now than residential. And obviously the value of the assets in commercial is directly proportional to the rent that you get. And obviously they value it on a capitalization rate or a yield. So as interest rates are really low, the yield has come down, which pushed up commercial asset values. Now, obviously there's a risk moving forward that with changes in the way people work post-COVID, that vacancy rates could increase. There's a lot of businesses right now that we know of that are renegotiating rents with their landlords, taking less space. So potentially that's obviously going to mean that rents will be dropping in commercial assets, which will pull values down. And over the next 10 years, interest rates are likely to go up from their lows that they're at right now. And as they do, values will also come down relative to the rent. So the yields are obviously going to change. So
you know, I was thinking about yesterday.
Mindful of.
Sorry, but you know, I was thinking about yesterday. I'm reading about these businesses that are struggling to pay their rent, and I was thinking to be a commercial landlord right now because they're getting all the heat on, and there's paper in the paper every day. There's stories about it's not fair. My landlord wants his rent. Well, just like everyone who's got a residential property, your rent helps you pay your mortgage off. So they look like they're the devil because they're expecting rent to be paid that people can't pay them. And I guess I look at our residential portfolio for our clients, and we're sitting absolute historical rental vacancy lows of 0.47% across the portfolio. We've got nothing to lease, everything's fully tenanted, arrears are at an all-time low. And you compare that to, I guess, the round out risk conversation on commercial property. It's just, mind-blowing how scary that would be right now to own a portfolio of commercial property.
Yeah, I think even if you look at the way, we've got near 1,000 square metres of office space for OpenCorp. And you're sitting here at home and you go, do we really need that 200 square metre kitchen, table tennis, basketball area? You start looking at that going to, I think every other business is going, we really need that. Maybe 500 or 700 would be enough to fit us all in when we go back to work.
Like your 600 square metre office unit at home works for you, doesn't it, Cam?
That's not bad. Yeah, go. Echo.
I think the other thing is the conversation that a lot of investors will be having in the next few years is going to be very inclusive of risk. Like maybe over the last 10, 20 years, there was a bigger focus, particularly for retirees or people moving towards or transitioning towards retirement, of what's my income. Now the focus is going to be what's the risk for the income that I'm getting. And as Al said, residential has proven through COVID that it's obviously a lot more tolerant towards, I guess, economic shocks, that there's very little variation of rental income. That's something that I guess we've only just seen in Australia this time. But if you look at the GFC, which obviously absolutely decimated America, and they saw the same thing, residential rents hardly dropped at all. In fact, they went up very shortly after the GFC, because as people lost their jobs or defaulted on home loans, they went and started renting properties. So they actually poured into the rental market while there was less houses getting built. So yeah, it's very resilient to economic shocks. So something else everyone should consider in their portfolio planning.
Cool. So Jimmy, the answer is no. I don't think about diversifying into commercial. He's got how to get more information on Resi Fund or potentially investing in it. Do you make one-off payments to invest or do you keep making instalments? If you check resifund.com.au is our fund page. You can do a contact us. You can email, is it Matthew at OpenCorp?
Matthew L at OpenCorp.
Matthew L at OpenCorp or Cam at OpenCorp. Matt can put you in touch with the funds management team to run through that. Usually people make a one-off investment into the fund, and then a lot of people just do standard installments out of their pay. So there's a number of different ways.
So similar to with the shares, you can obviously set up a regular savings plan to each month buy additional units in the fund, and you can have a distribution reinvestment going. So when there's cash distributions from the rent, you can use it to buy additional units in the fund.
Yeah. That's what Rowan's replied. What about if equity in the owner-occupier has gained through local market growth and the investment property in the market is stagnant? So Rowan's just talking again about the owner-occupier place and the investment property. If one's gone up in value, one hasn't. This is another really good reason having them with separate banks is really important. So we structure our clients' portfolio as they get larger. Each capital city sort of generally leans towards a single bank. And that way, if you get one capital city that grows in value, if you've got both properties with one bank and one market goes up and the other doesn't, goes sideways, back into the correction, the bank values your whole portfolio and works out your equity position. Having them with separate banks, if one sits there and one goes up in value, the bank just deems that property and assesses it and then can pull the equity out of that. So that's another reason we like to have them. Hopefully that's answered your question, Rowan. What do we got? Leonie, thanks guys for the advice is on point. Matthew summed it up with positive rent. Oh yeah, cool. That's a thank you. Appreciate that. What else we got? Pratik, when do you buy your dream house? Do you keep building the investment portfolio, use equity on those to buy the dream house, or go for it now? When do we buy it? So Felicity and I have been buying properties for at least a decade, maybe longer, building a really strong portfolio before she got pregnant with Hannah. And then when she was pregnant with Hannah, she said, I want my dream house. Well, we decided together, but we had a serious property portfolio. Everyone's different, but I would keep buying investment properties. I think both of you guys built serious property portfolios before you went and bought your dream house. Your dream house is much more enjoyable to buy when it feels like you haven't spent time working in a job to buy it. It's your investment property portfolio value going up to allow you to grab a heap of money and go and buy your dream house. So I'd say it's a lot more enjoyable buying that rather than buying it knowing you got a big debt ahead of you. Saying that you're still going to have debt, don't get me wrong. It's an individual question. I'm more than happy if you want, you can talk to one of the investment consultants at OpenCorp and they can run you through a couple of different scenarios. It might be the right time to buy, for you. But it comes down to personal life circumstance, what portfolio you've got in the background that's going to enable you to get where you want to go. For a lot of people, three investment properties is fine. You know what I mean? That gets you to your end goal. Some clients like 5, some like double digits. So it really comes down to a personal circumstance. What do we got? Nathan. So I've got, say, around 30K saved, obviously. Can't buy a house. Do I need at least 100? Yep, for a deposit plus a buffer. Good you're talking buffers, Nathan. If I was able to get a guarantor with my father, would seem logical, or should I have saved hard instead of trying to get onto the market earlier? Don't worry, I'm going to end up seeing you guys for a proper talk, etc. So I'm more than happy to you sit down with one of the investment consultants. They can probably map out and just say, you've got 30K there. How long is it going to take you to save to get a deposit? There's absolutely nothing wrong with getting someone to go guarantor as long as you're responsible enough and you've got a strong enough agreement in place that they've got you on the hook and you do right by the person that goes guarantor for you. Absolutely nothing wrong with that. But you've got to have someone that likes you enough to do it.
There's also ways for them now to secure their money in terms of structuring so that if you go off the rails or you get divorced or something happens, their money's protected. So, yeah, as Cam said, talk to us and we can see about giving you some advice there.
Yeah, we've come to the end of questions at the moment, so happy to punch a couple more through, happy to do a few more. 9 o'clock, we've been punching on for a fair while now. think just quickly some August data. So the index results for the capital city, national growth was negative 0.4%. Sydney was down 0.5%, Melbourne 1.2%, totally understandable in lockdown. Brisbane was down 0.1%, Adelaide, Perth, Hobart, nothing. Darwin had a 1% increase, Canberra had a 0.5% increase. So the property market hasn't moved. It's just sitting there waiting to tick along. So no major shocks or 30% drops in the property market this time.
And I think something else just to probably be mindful of there as well with that data, different states report their data differently. Obviously Melbourne and Sydney, which are very big auction markets, often will have their sales data reported after the weekend. Markets like Perth and Brisbane, which are absolutely going through a transition where there's increased demand and prices are definitely moving. From speaking to people on the ground there, the data just takes months to get into the system to be reported. So it's not as quick to turn around because they're not big auction markets.
Alan, I was just talking before you got on the Zoom, Louis, about rental vacancy rate data, and I was arguing that I like where I get my data better than where he gets his data from. But like we're talking very minute, and I know your team actually get it from about 6 different sources and then pull it together depending on what's going on and having your feet on the ground. But yeah, there is a lot of different data.
And I think as well, probably now across our portfolio that we manage at OpenCorp of over 1,000 properties, we have probably the most accurate data that we will rely on because we know exactly how many properties are vacant. And as Al said, it was something like 0.42%.
0.4.
Yeah.
Across over 1,000 properties. So that's that's quite telling as well.
Talking to the team at Domain Group and also the numbers out of REA.com, there's about a 30.5% increase in property searches for people who are saying they're ready to buy at the moment on those platforms. Overall, still Sydney and Melbourne are 6 and 10% above where they were last year in pricing. So we've fared pretty well. So
yeah, I was pretty amazed at the level of detail REA have. So they measure intent by someone who's been to the same listing more than 3 times and looked at every photo. Yeah. So I know that's a pretty good indicator. And then they put up some stats in relation to the increase in search demand and intent buying across the capital cities over the last 6 months. And Everett is up considerably from 12 months ago, including Vic, even through COVID.
Yeah. So I'll be the first to say if there's definitely areas and types of property I wouldn't be purchasing in. But boys, you ready to call it a night?
Yeah, spot on.
All right. Yep. Time to tuck the kids into bed. I'll see you at the protest march.
All right.
Good show.
Thanks for all the questions.
Thank you, guys. Thanks for tuning in.